This is video 2 dealing with a question that combines IAS8 with IFRS 9 and specifically share transactions in IFRS 9. We continue with the given information. The annual financial statements for the year ended 30 September 2010 have already been issued. Well, that makes sense because in the beginning they told us that we are busy preparing the financial statements for 30 September 2011. So last year's financial statements, the comparative year 30 September 2010, should have been issued already. Included in those financial statements, there were shares that we were trading with that this company, treated as inventories. And they explained to us what was done. How did we account for those share transactions in the shares that we were trading with? Even though that's not our main business, we are a manufacturing entity. We treated the shares as inventories. How? They gave us very specific bullets and the journal entries to determine what was done. So we know that we made a mistake. They said it was an inexperienced accountant and they incorrectly treated the shares as inventories. They made it very clear it's an error. And it is a prior period error. It is not an error in the 2011 accounting period. They actually say to us, the share transactions for the year ended 30 September 2011 have not been recorded yet. But even if they had recorded them, you are still busy with the 2011 year. That's your current year. You can still fix it. You don't need to tell people there outside the entity, you know what? While we were doing the financial statements, we made a mistake. We saw it. We fixed it. It's now right. That's not something you need to say. You're still busy with that year. If you see a mistake, fix it. You haven't issued those financial statements yet. The problem is the 2009 and 2010 financial statements have been issued. They are out there. People have seen them. People have made decisions based on the figures that were included in those financial statements. And in them, there was a mistake. And that is what a prior period error is. An error in one of the prior periods that were already issued. Mistakes have been made and the financial statements were issued with those mistakes in. And what does IAS8 say you need to do with a prior period error? It says go back as far as possible, preferably right to the start where you made the mistake the first time. Go back, fix it, correct the error as if it never happened. So if we draw a little timeline, there's our 2009 year. Our 2010, which is our comparative year. Maybe I should rather call it the prior year. And then it's our current year. Okay, 2011. So 2011, we're still busy with. We can fix it. That's not the problem. The problem is there was a mistake in the prior years. IAS8 says, go back to as far as possible. Go and correct the error. Fix those financial statements. And because you are changing financial statements that were already issued, we need to disclose it to our users. In the current year, the financial statements that we are going to issue now, in that year, in those financial statements, we have to disclose what kind of changes we made because we figured out there was an error. So in this example, the first share transaction was only on 1 March 2009. So we don't need to go back further than that. There were no share transactions before that. So it affects our year ended 30 September 2009, 30 September 2010. So we need to go back and fix those financial statements. Fix the financial statements issued in 2009. Fix the financial statements issued in 2010. But if we look at our current year financial statements, the 2011, what will I see in those financial statements? I will see the 2011 year and I will see one comparative year, 2010. I will not see the columns for 2009. Right? I won't see them because I show 1 year, which is the current year, and one prior year, which is 2010. But IAS8 together with IAS1 says if there was a prior period error or a change in accounting policy, you need to show in the statement of financial position a third column. So not only do you show the 2011, the current year, or the comparative year, your prior year, 2010, you also show a third column. And that third column that you need to show in terms of IAS1 is the opening balance of your prior year. Well, the opening balance of your prior year is the same as your closing balance, in this case of 2009. The end of 2009 will be the opening balance of 2010. But the column is called opening balance of your comparative period, opening balance of the financial year ended 30 September 2010. A third column in your SFP if you have a prior period error or a change in accounting policy. So any changes cumulatively, any changes that happened prior to your comparative year. So any period, and it can go back far. In this example, it doesn't go back far. In this example, there's only 2009 because before that, there were no share transactions. But it could have gone back 2008, 2007, 2006, 2005. It can go back very far. Any changes you make or that need to be made to fix the error or change in accounting policy, okay, same work method. Any changes you make going far back, all of those changes affect your opening balance of your comparative period. All the changes of all the prior years, all together, you need to show the effect on the opening balance of your prior year. So if it goes back 3, 4, 5, 10, 20 years, you have to do all of them together. What is the effect of correcting that error or the effect of changing that accounting policy, the effect on my opening balance of my comparative year? Because that opening balance, I will see. Where will I see it? Well, I will see it in that third column in my statement of financial position. Remember, statement of financial position deals with balances. So you will see the opening balance of your comparative year. Included in that opening balance, cumulatively, all together, are all the prior years. So if you fix those prior years, you need to show the effect on the opening balance of your comparative period. In the third column in your SFP. Where else can you see it? Well, there's an opening balance of the comparative year in your statement of changes in equity. You need to change that opening balance of retained earnings. You need to show the effect of having gone back, having fixed an error in many prior years. In this example, only 2009, but it could have been more years. All together, all those years, what is the effect on my opening balance of my comparative year?